सारे जहाँ से अच्छा हिंदुस्तान हमारा, right? 18,600, 500 points away. Who would have thought we would be here when there is war in the world, when rupee is at 82, when there is a problem in terms of what is happening to Europe and US, but Indian markets are holding on.
Absolutely, Nikunj.
So where do we go from here? I mean, should we focus on valuations? Should we focus on, or should we not focus on macro and valuations? Because right now it's momentum and it's liquidity which is making all the difference.
Absolutely, Nikunj. I think the Indian markets have been very, very resilient. And in an environment where there's a perfect storm globally, look at any global markets, it's down between 20 to 30% calendar year to date in dollar terms. And Indian markets have been a clear outperformer. The valuations today versus emerging markets are, and the rest of the world is at all-time high now. So valuations clearly are one or maybe two standard deviations above the long-term averages. The flows have been positive. Last 6 days, we have seen FIIs buying to the tune of 14,000 crores. Last 2 months, the selling intensity have come down. We believe from here on for the next 6 to 8 months, it has to be a bottom-up approach rather than a top-down approach, and look for companies which probably can, weather this storm which has been there globally. In India, I think a couple of points to note. On the macro side, I think one concern which is emerging is that liquidity is getting tightened. Across the board on the conference calls also, managements are alluding to working capital cycle elongation. Deposit rates have started to move very fast. We are seeing that credit growth of 15%, but deposit growth is not keeping pace. And our sense is that banks over the next 6 to 8 months will raise deposit aggressively to fund their credit growth. So liquidity, which was in surplus for all the last 3 years, have started to come down, which is a matter of concern. Second, I think the global interest rates can remain higher for longer. And this is something we need to watch out for, because if you today look at a 2-year US Treasury, you are getting 4.7%. And add to that 2.5% of rupee depreciation on a normalized basis. So you are roughly getting about 7.25% on a US Treasury asset, which is not a bad yield for any global investor. And my sense is that will weigh on the flows at some point of time going forward. The third point to note is the geopolitics. I think clearly on the China side and the Ukraine-Russia war is not giving us any respite, and that we need to be a little careful of. So these are some of the concerns which are emerging incrementally. But the positive point is that this is after a long time that market participants are cautious on the market, but corporate India is extremely bullish. And they are seeing a very bright future over the next 2 to 3 years. We traveled all across the country, Nikunj, and the sense we are getting in the engineering belt is that the order books are full for next few years, mainly led by orders from China and Europe. The PLI scheme is doing a good job, as well as the capex intensity in the domestic market is picking up. So I have not seen entrepreneurs so positive for last many, many years what they are today. So I think that's what is reflecting in the market being so resilient. In a land where there's growth could be scarce going forward, India could be a bright spot in that scarcity.
Some of your thematic ideas, Pankaj. Morning firstly, where within mid and small caps do you find value?
We believe that the medium-term thesis doesn't change from the last time. Industrials and manufacturing is one space where we are seeing good traction. Order inflows continues to be strong. And we believe that if you look at this cycle, first the order inflow starts coming in, which reduces the pressure on companies and managements to take order at any price. And then revenue growth follows, and then the margins. And I think this time the cycle is not looking very different. Order inflow for the last few quarters have been extremely strong, and that's the sense we are sensing going forward as well. That will be followed by top line growth, and then margins will actually flow down from the cyclically low levels today. So I think manufacturing and industrial cap goods looks to be a very sweet spot to be in. We have seen a very strong performance by financials. I think for the next couple of quarters at least, the financial seems to be in a good space. And both large private sector banks and large PSU banks are well positioned in a rising interest rate scenario as well. The third is the auto pack, especially the passenger vehicles and the commercial vehicle segment. We believe that the traction there has been extremely strong. Even the festive season has been very strong for most of the automakers, both on the passenger vehicles and the commercial vehicle segment. So these are some of the spots or the themes which we are liking from a medium-term perspective. One dark horse which has started to look good from calendar 2023 perspective is Pharma, but that has to be a stock-specific approach. Incrementally in this earnings season after a long time, most of the large pharma companies have reported either in line or better than expectation results, which is a deviation from the last 4-5 quarters. So I think the worst in terms of US pressure is behind us. Domestic market in pharma is doing well. Valuations in our favor, very little to lose. And I think in this market, the question we should ask is where we should not lose money rather than where we should make money. I think we are at a point where we need to assess risk also and not get just carried away by the momentum.
Pankaj bhai, banks is a very generic word. There is HDFC Bank, big, large, growing, and there is a Karur Vysya Bank, small but impressive set of numbers. For an investor, which is the best pocket right now to park money and generate absolute returns? There are times when great banks may not make money, and PSU banks have made money in last 2 years. So as an investor, where is the margin of safety and return potential highest? Which end of the financials?
So our preference, Nikunj, lies with the larger private sector banks and larger PSU banks. And the reason is that, deposit rates have started to move very aggressively. And the banks who have large CASA balances will finally be the beneficiaries. If you look at many of the smaller banks, they are wholesale funded or either the NBFCs. And we have seen in some of them, the pressure have started to reflect on their NIMs already. Our sense is that Q2 or maybe Q3 will be the peak in terms of NIMs for most of the banks in the sector. And hence banks with better retail franchise on deposits will probably gain disproportionately as you move ahead. Don't forget that many of the large, good private sector banks are raising 1-year CDs at 7.5% now. And that I think is not still reflected. The average cost of deposits today in the system is 5.5%. And the 2-year GSEC bond yield is 7.15%. Don't forget the average tenor of deposits in the system is about 1.5-2 years. It can't be that government of India is borrowing at 7.15% and the average rate of deposits in the banking system is 5.5%. So there's a very large gap, and I think that gap will narrow down over a period of time. Hence, our preference lies for banks which have strong CASA and can, weather this rising interest rate scenario.
Okay, so Pankaj, you talked about the sectors and segments that you like, but let's talk about the spaces to avoid at the moment. Which are those pockets that you think will likely underperform? Is it IT and consumption staples? Because those are the sectors you haven't mentioned as of now.
Yes, absolutely. IT, we have been cautious for a while. And I think the commentary coming out of either global or Indian IT companies are not giving us any comfort. There's global macro uncertainty. We are seeing that layoffs have started by the large companies in US. And I think that will weigh down on the IT budgets as you move into 2023. And we believe that one round of downgrade is still pending. And that will weigh on the valuations of most of the IT companies because they are still trading one standard deviation above the long-term averages. So we continue to have a cautious stance on IT as we speak. The second one is on the consumers staples. It's quite amazing to see that the consumer staple 3-year CAGR growth is either flat to negative. That means that the bottom of the pyramid has been hit very hard. And most of the consumer staple companies, even in their call, mentioned that things incrementally may look better, but still not to the pre-COVID days. So our sense is that valuations are not supportive there to the growth which these companies are offering. And our sense is that consumer staples is something which one should, be incrementally cautious about. The only thing out there is that margins may likely improve because commodities have started to correct, whether it be palm oil, wheat, flour, and that should aid margins incrementally. But demand is something which has been hit very hard at the lower end of the pyramid and the low income households, and we need to have a careful view. And that's also showing that the economic recovery is not in full steam as markets is pointing out to be.
Okay, Pankaj, great to have you on the show. We'll let you go on that note. Thanks.